Hello and welcome to The Pitch. My name is Chris Conway. Today I'm sitting down with Benjamin Leung from Macquarie Asset Management. He's the head of the Systematic Investments team and he's going to be giving us an introduction to systematic investing. Let's start at the beginning. What is systematic investing?
Systematic investing is a passion of mine. I've been doing it for 20 years. And I feel like systematic investing really is a natural evolution of some of the classical investment principles, but in line of, the increasing complexity of the world, in light of all the increasing knowledge we have of how the markets function and how investors respond to the markets, and ultimately also a process to lean into some of the benefits of the latest technology that we are uncovering with AI and data. At its core, it's utilizing many of the principles that our investors would be familiar with. We are not a black box process. We are not seeking correlation. We are not high frequency. And we're leaning on similar concepts that a fundamental investor would utilize in the form of valuation, in the form of assessing a quality of the company, but building on top of that with the knowledge that those fundamentals don't exist in a vacuum. There is an interaction of investors with that fundamental, and there's interaction between investors as they interact with that fundamental. And because of our behavioral biases, we find that those interactions are often suboptimal, and they create opportunities for our process. And the systematic portion refers to our mission that we want to create a transparent process as to how we deploy that insight into the financial markets in a way that brings scale. So we're covering 3,500 stocks across the investment universe for our investors in the way that it's making the most of technology and data. Each of our investment decisions uses billions of data points, and ultimately to create a process which translates into a more reliable, a robust, and repeatable source of return for our clients.
Ben, you talked there about some of the biases that we humans exhibit as investors. What are some of the common ones?
I would take a step back. These biases actually interfere with our general decision making, right? Not just investment decisions. And the interesting thing about these behavioral biases, once you kind of learn about them, you start seeing them in your own behavior. In that moment of quiet reflection, you go, oh no, hang on, I just gave into that particular bias. Some of the more common ones, people have a tendency to copy what other people are doing, particularly when there's incomplete information. If you think about all those pranks where people just stare into the space and go, everybody starts looking. When you're looking for something to eat at lunch, you kind of just gravitate towards the one with the longest line. Those are all exhibits of that behavioral bias. A couple other ones, we as humans have a tendency to be asymmetrically risk adverse. And if you think about how things work in the nature world, there's such a great risk of getting injured or falling ill that obviously to be successful, you have to place particular emphasis on the downside. Mm-hmm. Other ones, conversely, we actually have a preference for lottery. The chance of winning a lottery, as we all know, is minuscule, but yet, thousands and hundreds of thousands of people participate in this competition every single day. And one of my favorites, and maybe relate to DIY enthusiasts, is the IKEA effect, the furniture making company. For whatever reason, we just think the stuff we put together, or ideas that we bring forward, is so much better than everybody else. And you can see, how that can create challenges in the investment context. And I guess that the bias gives them a bad rep, but ultimately these are mental shortcuts that's actually made us successful as humans. So, displaying these behaviors actually makes you a great example of being a human. But sometimes it just doesn't work as well in the financial world, really, and that's the challenge. The behavior themselves is not an issue, it's just whether they're effective in the financial context.
Ben, some really great examples there that I'm sure everyone can relate to. So now that we're aware of them, what research suggests that they're a problem when it comes to investing, and then how does having a systematic approach help overcome them?
There's a great deal of research and our own experiences support that these, behavior do occur in the markets. And for people who are interested, there's a lot of easily accessible materials. Books like Think Fast, Think Slow, Predictably Irrational. They cover, the pitfalls of these bias in the context of investment decision making. In the context of the financial markets, if we look at the examples that I've talked about, herding obviously create trends can create trends that lead well beyond a rational valuation, both on the upside and on the downside. In terms of risk aversion, a stock that's fallen or has experienced a large drawdown are shunted by investors to the extent that they would potentially overlook great valuation opportunities. In terms of the lottery effect, there's likelihood that you overpay for the pursuit of 10 baggers. And the IKEA effect ultimately is you tend to hold onto your own stocks for far too long. These are all opportunities and I guess concepts that we captured in our process. And in our 30 years, we've explored thousands of these factors to distill down to I guess, the metrics that we feel would most likely predict investor behavior in the future.
Ben, a nice segue that you've provided there. Is the role of systematic investing to eliminate biases and invest, say, more purely, if you will? Or is it to take advantage of the biases that are always going to be prevalent in other investors, or both?
Yeah, the answer is actually both. And I feel like our track record and our success gains credit from doing both of those things well. I mean, we have great admirations for classical investors who are able to fight against their tendency and their behavioral biases to make bold bets. But what systematic offers is that you don't have to fight every fiber of your being with every investment decision. The systematic process allows you to do that in a very natural way, and also allows you to do it in a way that you can create better and better mousetrap for these behavioral biases, both for our clients and also to protect our clients from in our own investment process.
Ben, last one. Once these biases are quantified, factors are then used to capitalize on them. Can you just give us a real-life example of what that looks like?
Yeah, I mean, if I just take the herding example, where trends are created and continue generally for a period of time, really simple way to implement that observation is simply by buying stocks that has gone up and avoiding stocks that have gone down. Of course, to identify that, you can use the price appreciation in the last 6 months. But of course, you can continue to enhance that metric to give you greater efficacy. And the things that we would do would reinforce that metric with traded volume. So things that have greater traded volume display greater conviction. You can obviously enhance that with a level of valuation in there to work out whether it's overstretched or how much it's overstretched by. And of course, you can deploy sophisticated techniques like AI and things like that to further enhance the metric. And ultimately, that's kind of the process we go through when we create a factor. And as I was saying before, we've gone through a journey of refinement over the 30 years. And in our factor toolkit, not only do we have sentiment indicators, which I just shared, we have quality metrics, we have valuation metrics, we have insights on how informed traders are thinking about the markets, we have insights as to how long-term holders are thinking about the market. And ultimately, we're trying to bring all of that together in a robust and transparent way to create that source of alpha that we spoke about at the beginning.
Ben, sounds absolutely fascinating. Thank you so much for sitting down with Livewire.
Well, thank you, Chris.
If you enjoyed that episode of The Pitch as much as I did, make sure to give it a like, and don't forget to follow our YouTube channel because we're adding lots of great content every single week.